Good morning, students. So, just for now, 15-20 minutes, I will complete the bank reconciliation. I hope that you are able to understand whatever I have given and you are able to see the slides. Last class, I have shared the slides to you. So, if you practice whatever I have given, that will definitely help you for your CA Foundation exam. So, whatever problems I have given, start practicing it. Before I start, I want to tell you one thing before I start the slide. Now we'll be talking about the overdraft. Once again, I'm just telling the overdraft to clear the confusion between the overdraft and the normal balance. This normal balance is the favorable balance and the overdraft is the unfavorable balance. Now, the first thing is what we should remember is whenever we are going from a passbook to the cash book, we have to rectify the errors which are there in the passbook. But we should accept the errors which are there in the cash book. Similarly, whenever we are going from cash book to the passbook, if you want, you can write it down also. You have to remember, sometimes writing is also essential whenever I'm saying also, because some things I will say, some things are there in the slides. So whenever we are going from the cash book to the passbook, what happens is the cash book, you have to adjust all the errors.
Sir, sorry to interrupt you. Please open the first slide. The slide is coming black. Can you please see?
Okay.
Yeah, it's written checks issued. So please
Acha,
start.
it is showing only checks issue.
Yeah. It is.
No, I have kept it like that. Then I'll start. I have just kept it like that. It will start again now.
Okay.
Yeah. So for that reason, we have to see that how the overdraft balance and the passbook balance, cash, overdraft cash and overdraft passbook, how they move around. So let us see through these slides, whatever I was telling you. So we are going from the BRS process from overdraft to the passbook. Now, when I'm going from overdraft cash book to the passbook, what I'm doing is I am subtracting the checks issued. Last class, we discussed the same thing. I'm adding the checks deposited and I am subtracting the bank receipts. And what I'm doing is I am adding the bank charges so that I am getting the overdraft passbook. Now, this, whenever it may create a confusion, the how to remember this equation, just remember one thing. Now, this is where you are going to reverse, and this is bank receipts is decreasing and bank charges increasing. Now, to explain this point, I will give you a small example here to explain this point here. Now, just understand that you have 20,000 in a overdraft in a cash book, right? Overdraft is like a credit balance in a cash book because you don't have its debit balance is a favorable balance, 20,000 credit balance is an unfavorable balance. Now, what happens is whenever you're issuing checks, what happens? When the checks is issued, definitely the balance will decrease, that cash will come out. It is outflow of cash. So what happens? Checks issued is a credit balance. Now 20,000 was credit balance. Checks issued is a credit balance. So credit balance increases. Similarly, when you deposit checks, it is a debit balance, right? So it decreases your overdraft balance. So you see credit balance and credit, it increases the credit balance. Credit balance and debit, it decreases the credit balance. So for that reason, whenever I am going from overdraft to the passbook, first of all, I have to reduce the balances of which is increased and increase the balances which have decreased. So first of all, what I do is I reduce it by I subtract in the checks issued and I increase it by adding the checks deposited. So thus it is just the reverse of the normal or the favorable cash balance. So same thing I am showing here in the overdraft passbook. What we have done is just the reverse. We have subtracted the checks deposited because as I told you, passbook is the mirror image of the cash book. Okay. So we have subtracted the checks deposited, we have added the checks issued, and we have subtracted bank charges and we have added bank payments. So here what happens is, in that case, you get an overdraft cash balance. So to explain this point, I will tell you, now suppose 20,000 is the unfavorable or the credit balance in the cash book. So similarly, 20,000 debit balance is a favorable balance is the unfavorable balance in the passbook because for a cash book, credit balance is unfavorable. For a passbook, debit balance is unfavorable because bank and cash are the books of the bank accounts and cash books, they are the mirror images. So what happens is now if you there is a bank charge, okay, it deducts, and what happens? There is a debit, it increases. But when there is a bank receipt, its income is coming, it is a credit. So there it is decreasing. So what happens is whenever you are going from passbook to cash book, what you do is you subtract the bank charges, things which increase the balance you subtracted, things that's why you minus it, and things which decrease the balance you add it, that's why you add the bank receipt. So this is the way we will be trying on our problems. So those who want me to talk in Hindi also, I will just after the English, I will tell what are the problems I'm addressing. So quickly we'll look at two problems, which are the illustration, and two problems which are in the for the CA Foundation exam, which have came. So the formats are almost they are similar, and they have asked whatever questions, whatever discussions I've made in the slides, the same things we could find in the coverage of the CA Foundation exam. So once you understand the concepts, we will definitely be able to address such questions. So here what I am seeing is we are having a bank overdraft. I just took a typical bank reconciliation statement where there is a bank overdraft. Now, when there is a bank overdraft, what happens is it is a credit balance now for the cash book. The black arrow, it is showing interest which is debited by bank, but no advice received. That means known to bank, but not known to company. Check issued is, again, it is known to check issued, but not presented. It's known to cash book. Transport subsidy received from state government, known to bank. Draft deposited in bank, not credited, like checks deposited, not credited. Bills for collection. Somebody last class was saying that bills is very difficult to address and understand. Through these slides, I will show you how easily we can understand such type of issues. And you must write down some of the 2-3 formulas, but I'll tell you verbally, so that it will help you to tackle the bill of exchange problems. Now, bills for collection is credited by bank till 31st December, but no advice has been received by the company. Now, it is credited by bank, but company doesn't know about it. So this is given. So these are the amounts. Finally, if you see here, this is another amount. So you can see green is all the green color arrow tick marks are all the known to the company, and black color tick marks are all known to the bank. Just we see it correctly. Then you can see the yellow mark is there. It is amount which is wrongly debited to company account by bank, for which no details are available. Okay. For which no details. So the amount is wrongly debited to the company account by bank. So who has done the error here? The error is done by the bank, not by the cash book. So the error is done by the bank, and for which no details are available. That is 7,40,000. So it's clearly written that the error is done by bank. Now what you did is you overdraft, you took it, add the interest charged by the bank, you added it, because when there is the overdraft as per cash book, you will add all the bank charges. Then draft deposited in bank but not yet credited. That means, so bank payment you did it. Draft deposited in bank but not yet credited is similar to check deposited but not yet credited. Yeah, you are adding it here. It's a deposit. Now error. As I said, error has been done by the passbook, and you have to accept that error because you are going to the overdraft as per bank statement. So what you do is you add it up. Yes. I'll take short questions only, because once we complete today, we'll go to inventories. Yes, Pranab, be quick. Please ask your query quickly.
सर वो पीछे जो स्लाइड दिखाया था ना,
हाँ,
उसके मुझे सही से बताना।
I cannot
पीछे
hear
जो
you.
स्लाइड दिखाया था,
Which one?
पीछे जो स्लाइड दिखाया था ना, उसका मैं समझ नहीं पाया।
Please talk in Hindi, English. Can you talk in English?
लेफ्ट शो मी स्लाइड ऑफ रोल।
आपको दिखाई नहीं दे रहा है क्या? मैं क्या हो रहा है? Yes, Suhana Sen, you have any doubt?
Very good morning, sir.
Yes, good morning.
Sir, the doubt is related to the previous class. So can I ask now, sir?
Previous class, the problem is there.
Yes, sir.
Okay, tell me.
Sir, it is with the illustration number 6, which is there in 3.27, sir, in the material, sir, study material. So in that, the last point, I have concern with the 7th point, like a check for 27,000 rupees was drawn by B. Philip that had been charged to A. Philip's bank account by mistake. So in that, like, since like the 27,000 was being drawn by B. Philip, means it would be considered as drawing, na, sir?
See, who has done the error? Can you tell me? Last class I explained it correctly. So what I request you is once you practice it and again come back to me. Once you check it once, try it.
Sir, like I have already done it, sir, but still I'm not getting it. I mean, like since it has been wrongly charged to the A. Phillips bank account, so that has to be rectified. But why again this 27,000 rupees has been deducted is something it's not coming into my mind, sir.
No, I explained already. If you see, we have to go to that question to see what is that, whether you are arriving at the passbook balance or the cash book balance, right?
Sir, actually
I explained it. It is a mistake by the bank, right?
Yes, sir.
If it is a mistake by the bank and you are traveling to, cash book,
Yes, sir.
so in that case, you are rectifying it and you are coming. But if you are traveling from cash book to the passbook, you have to accept that mistake.
Okay, I mean, the drawing has been done by B, but it has been charged
See,
against A, sir.
first
Sir.
of all, when we see this sentence, what we know that who has done the mistake?
So the bank has done the mistake, sir.
So bank has done the mistake, right?
Yes, sir. Yes,
So
sir.
it is the rectification should be done by the bank, not by the cash.
Yes, sir.
Okay,
Sir.
understood?
Yeah,
Okay.
yes, sir. I understand.
Okay, thank you. So Suhanasan, you have any queries?
So no, sir. But once again, I'd like to go through the problem once again. If I have doubt, then I'll asking you in the next class, sir.
Okay, fine.
Yeah, thank you, sir.
So what I would suggest students to look through these illustrations. Once you do through this, then you will be able to answer all the questions. So I have incorporated two CO foundation questions, two, three in this slides to show all these points. So what I was talking about is we were at this deposit. Now we see just now when we were talking about the checks and everything about errors. Error is done by the bank. It is a wrong debit by the bank, and it is under verification. So what we are doing here is, but we are adding it. We are not rectifying it. Why? Because it is a mistake of the bank, but when we are going to overdraft as per bank statement, we have to accept it. See, we can rectify our books. We cannot rectify others' books. Similarly, wherever we are going from one book to other book, we have to go out as per their books. Now, what happens is here, as per the books of the banks, they have done a mistake. But why we are adding it? So that we can show in the reconciliation that due to these reasons, this is the balance of the cash book and this is the balance of the passbook. That's what our objective is. That simply. So now what happens is we got the this is what we get after adding 46 lakh 14 16 600. Then what happened is, as this is the cash book, so what happens is we are deducting the checks issued but not presented to decrease the balance. Then transport subsidy, whatever is not recorded in cash book, we are also deducting it. But transport subsidy is not yet recorded and it is a bank receipt. And bills per collection, try to understand, bills per collection credited in the bank yet not entered in the cash book. So this is like a bank receipt. Bills per collection, simply a bill of exchange, not discounted. If you want, you can write it down. Bills for collection is a bill of exchange, not discounted by the bank, sent to the customer. Customer has accepted it. Customer has sent the payment. And so bills per collection is credited in the bank, but cashier will not know about it. So it is deducted. It's a bank receipt. And so it is deducted. 8,36,000 deducted. So now you are getting your overdraft as per bank statement 1693,600. Now overdraft as per cash book was plus, overdraft as per bank statement is also getting plus. So both are getting unfavorable balances. I will show you where next slides where I will show you that one is unfavorable and another is favorable. Before that, shortly, Prazul, just ask your question very quickly.
Sir, can you solve the question number 9, sir? It is given cash book of different months. I mean, cash book is given of March and bank statement is given of April.
Is it there in the slide?
Yes, not in slide, I think, sir.
Okay.
It is in material.
What I would suggest you is, you can tell me question number 9, right?
Yeah, sir. Okay. Illustration 9.
I'm noting it down. Although we will discuss inventory, next class I will try to see what is the issue you are facing. Okay. Can you tell the page number?
Page number 3.31, sir.
3.31. So what is the issue here? What happened there?
Cash book is given of 3rd March. I mean, month of March, and the bank statement is of April.
April. So from 3rd March, what is the question? What is the question is asked there?
Same, sir. Reconciliation we should do.
Mm-hmm.
But they gave only the cash
what
book.
Is asking? Prepare BRS. That's all.
Reconcile the bank balance of cash book, sir. They gave.
Okay. Transactions, any dates are given for the transactions?
No, sir. They gave the statement, sir. Bank statement and the cash book account, sir. I mean.
So did you try it once?
Column.
Did you try it once?
Yeah, sir. I tried, sir.
Did your answer match with that with the material?
Yeah, sir. It matched, sir.
So then what's your query then?
So what we should do? We should add or subtract. I mean, we should do opposite.
No, I already gave the equation. See, whenever you are solving, see the equation and solve it. In the slides, I have given some equations, 4 equations. 1 for favorable balance, 2 for favorable balance, 2 for unfavorable balance. refer these equations and always solve. We'll have no doubts then.
Yes.
Okay. So now we are going to one condition which last class I discussed. Till then, I just wanted to stress upon that.
Sir, sorry to interrupt you.
Yeah.
I can discuss that illustration 11 because illustration 9. I think one student has asked about the illustration 9.
Yeah, I noted it.
Yeah, I mean, I would like to interrupt. I would like to resolve his query if he is
Yeah,
available
sure.
here. Are you there? What was his
Prajal,
name?
are you there? Prajal.
Prajal. Okay, Prajal. Yes. See, you were saying the cash book was for March and April, and the passbook is given for April. See, it is the year-ending cash book, right? Year-ending cash book. So here you have to see the balances and then tally it. So I don't think there is any problem in it. The only typo error in this is at the end, at page number 3.32, it is 30th of March 2021. It should be 31st of March 2022. That's it. You tell me what's your query in this question. Prajal? Prajal? Yes, please ask your query.
Ma'am, if there is a overdraft, how to solve this, ma'am?
If there is an overdraft, sir have already told you if there is an overdraft, then you have to add or subtract accordingly. Overdraft means the
For this
balance
type of
is more,
question, ma'am.
the credit is more than debit as per the bank statement. Debit is more than credit as per the bank statement. So accordingly, you have to add or subtract. For
Then what we
example,
can
if
do
there
is-
is an overdraft and the bank has charged interest, already bank has charged bank interest. So in that overdraft, we have to add that amount. Since the amount, it will be charged to the customer, so the amount will obviously, overdraft will increase.
Yes, ma'am.
Okay.
I will try it once, ma'am, again.
Yes, you try once. See, the cash book is given as per 31st March 2022. Then from the balances as per passbook is from 1/4/2022, which is not tallying with our cash book in that question. So what is the cause of difference? That has to be taken care of in that question. Okay?
Okay, ma'am.
Okay. So
Thank
you
you.
can kindly continue. I thought I know this answer, so I thought let me
sure.
hear it out.
So if at all they face a difficulty, we can within this half an hour session also we'll show them the study material. We'll share it and we'll try to address
Resolve that. Yes, sir. Yes, sir.
Sure,
Please
no problem.
continue.
So right now, because we have to start another session also, this inventory is there pending. So
Yes, sir.
So here what we see here is one balance is there favorable and another is unfavorable. Right, you can see now that on 30th September 2022, the bank account of X according to bank column of X book, cash book, was overdrawn to the extent of 4062. Now, overdrawn means very simply you can tell that it is for the bank it is a debit balance, but for the cash book it is a credit balance. Now, the bank statement showed a credit balance. Now, if we see here, what is happening is that the bank statement is showing a credit balance. So whether it is a favorable balance or unfavorable balance, I want to ask the class. Anybody can raise their hands to answer. The bank statement is showing a credit balance, whether it is a favorable balance or unfavorable balance. Yeah, Shivanand. Suhana
It's
said
favorable.
it is. Yes. Shivanand. Naina.
Yes, sir.
Yeah. What is your answer?
So bank statement is showing a credit balance. It is a favorable balance.
Yeah, very good. Favorable balance. Aman Gupta.
Yes, sir.
Yeah, what is your answer?
It would be favorable balance.
Yeah, very good, Aman. So what we are finding here is that one of them is showing credit is overdrawn, unfavorable balance, and another is showing a favorable balance. So what we have to do is what in this case, how we are solving it, how we are going to a reconciliation and how we are finding an answer to this. So one is unfavorable and another is favorable. So here we have some statements. We can see that the green one I'm marking is, this is all the check transactions. And the blue one is for the errors. Now, if you see here, a check is deposited on 29 September and it was credited by bank on 3rd October. So, the checks deposited, not credited. So check transaction is green color. Then, yeah, Ashu, you want to ask something? Ask quickly. Ashu, what's your doubt? Ashu, are you there? So there is a payment by check which has been entered twice in the cash book. So who has done this error? Payment by check of rupees 16,000 has been entered twice in the cash book. So definitely the error has been done by the cashier side because it is entered twice in the cash book. And here, this is a cash book error. Then we can see on 29 September, this is the black arrow signifies the things, records which are known to bank but not known to the company. So we can see on 29 September 2022, bank has credited an amount of 1,17,400. Bank has credited. But it is not known to the customer. Customer has not known. So what you do is whenever you are finding such type of instruction, causes of difference, just write that amount and just write a small narration so that when you are reconciling, you'll take those points and you will have to just put the slides, whatever equation I am given, check that equation and corresponding equation, you enter in with your reconciliation statement. So this is the third one we got to know. Fourth one, what you know that bank charges 580, they have not entered. Bank charges 580 has been not entered in the cash book. Then bank has credited 20,000 to X in error. So this is an error by the bank. So second point dealt with the error which is in the cash book side, but the fifth point dealt with the error which is on the bank side. So second one is the error by the cashier, fifth one is the error by the banker. So blue ones are all the errors, blue error ticks. So this is a passbook error. Then what happened? Now we see a bill of exchange. It's not a collection. It has gone for discounting. 1,40,000 was discounted by X with the bank. Now what happened? That which was earlier discounted, which might have increased this cash balance. What happened? This bill is dishonored now on 28 September 2022. Now, when it is dishonored, it is not known to the company. So company thinks that the bill, I have received the money and it's still there with me. A customer must have paid to the bank. So why it will be dishonored? But probably the customer has become bankrupt or something has happened. So the bill was dishonored. Then the green one is checks which are issued but not presented for payment. So checks issued and not presented for payment is 13,26,000 issued but not presented for payment. Now what we will do is we have to adjust the cash book or the bank column. So what we have to do is, first of all, if you see here, date particular amount we write, debit side is all increasing and credit side is all decreasing. Now what happens is 16,000 was an error. Twice they have entered the cash book, checks issued. So actually it is decrease the cash balance. So what we do is you included it in the debit side. Since it has taken 2 times, so it is reducing the cash balance by credit side, then nullifying it by debit entry on the left hand side. So it is party account 16,000. Then what happened? You brought the balance brought down 4062 overdraft. It is a overdrawn balance. So you brought in 4062. What happened? Customer has directly deposited, direct payment has been made to the bank. So you have got an increase in your cash balance. So you made a direct deposit because you are now preparing the adjusted cash book. Then what happened? You brought bank charges 580, which should reduce it, and the bill receivable, which is dishonored, 1,40,000. You have taken into the account. So this way you tallied it and you got your balance carried down is 11,242. Now my question is whether this is a favorable balance or unfavorable balance. The question to the class is whether this is a favorable balance or unfavorable balance. Can anybody say? Yes, Prajwal.
Unfavorable, sir.
Very good, Prajwal. It's unfavorable balance. So you can see here, it is a unfavorable balance. So now what we do is, when there is unfavorable balance, we start now we got that balance now, adjusted cash book, and we start our reconciliation. What happens in overdraft as per cash book? We add the check deposited but not collected. How much it came? 13,14,000. So this is where is added to the checkbook. As per equation, overdraft cash balance will add the check deposit. So 13,14,000 is added. So it comes 13,25,242. Then what you do is checks issued but not presented for payment is 13,26,000, which has to be subtracted. Now what happens is we are going to the passbook. So we have to accept that error, which is done by the passbook. So this credit we deducted it from our overdraft, which is 20,000, so that we arrive at our bank balance. And actually it is minus. It will show minus 2758. In your study material, it has shown 2758 and it has said it is unfavorable balance because when you add it, all these things, it will come minus. So it is a favorable balance. Okay, because if this is plus and this is minus, it is a favorable balance. So now from the unfavorable balance, due to some transactions, you have reached a favorable balance. Yes. Yes, Sohana Sen.
Sir, once again, could you explain the point of bill of exchange, sir?
Which one? Okay. Which is discounted and dishonored, right?
Yes, sir.
So it is just like a check dishonor, right?
Okay.
Checks, what you do is you give a check, you take a customer check, you give it, or customer's check, bank deposit somewhere. Customer doesn't have money means it is dishonored. Similarly, bill of exchange, when they discount it, what they assume it that customer has to pay after 30 days. So what bank does is, suppose 60,000 is the bill of exchange amount. Bank discounts it, 59,000 gives it to the company, and rest 1,000 is the charges, and it collects from the customer the bill for after 30 days. Okay. So after 30 days, what happens? The customer may have become bankrupt. He is not able to pay. So what that happens is, whatever money, it is a bad debt actually, which bank has discounted earlier. So what bank does is now it reverses that amount. It asks for a dishonors. It dishonors that bill of exchange. Like check dishonor, it dishonors the bill of exchange because party is not ready to pay. So it now bank indirectly asks the money from the company.
Okay, sir.
So the treatment is like check dishonor. Okay.
Okay, sir. Thank you.
Okay. Thank you. So now we can see. I will go quickly. This one you solve it yourself. I will just so if any doubt we can discuss in next class. This I will talk later on. Similar thing. I will go to a June 2024. This one slide which I already discussed skipped because I thought people should once practice yourself. If you face any difficulty on that slide, please talk with me in the next class. I will solve it. Okay. Once you see this particular any topic, I missed it. I just skipped it knowingly so that you will practice it yourself. This is because I wanted to focus on the foundation questions, some of the foundation questions from very recent, to show that how they have been given and how we are going to solve it. So first primer thing is keep the equation intact, keep the equation ready. And now this is the question from your June 2024. What it is done is, this question is only 5 marks. So it depends when the bank reconciliation, it may ask for 5 marks and it may ask for 8 marks. Usually if it is 5 marks, they just ask a BRS. And if it is for 8 marks, they ask usually the adjusted cash book and then they ask the BRS. So depends on how lengthy it is to be solved. So this is just a plain 5 marks question, similar to the question I gave in that illustration, from the illustration I was discussing, that bank overdraft as per cash book is 24,000. Then check deposited as per bank statement, which is not recorded in cash book. So check deposited as per bank means bank knows it, but cash book doesn't know it. I have ticked it a blue arrow for which bank knows it, but cash doesn't know it. Then blue is, the yellow is the cash which is received from XZ was entered in the bank column of the cash book. So can you tell me who committed this error? So this yellow is an error. So who committed this error? Can anybody say? Yes, Aman has raised hands. Naina has raised. Somil. Let us ask Somil once. Let us see what Somil has to say.
The businessman.
Businessman. Why you think businessman?
Because sir, cash collected. We collect cash, so we need to write in the cash
So
column.
is it a cash transaction or is it a cash transaction or a bank transaction?
Cash transaction.
Very good, Somil. It is a cash transaction because cash is received, but what happened? The cashier erroneously entered it in the bank column. Good. Then debit side of the bank column is casted short. Okay. Whose error it is? Yes, 2 participants raised hands. Let us ask Aman. Aman, whose error it is?
It is bank's error.
Debit side of the bank column Cash gesture. Okay, Aman is saying bank error. Let us
No,
ask.
sir. No, sir. Cash, sir. Cash. The business error. It
Yeah.
is.
So
I got
it
confused.
is, yeah, it is better to tackle the bank reconciliation problem first in the examination before
Yeah.
the other topic, because normally these transactions you have to visualize again and again. So it's normally
Yes.
better to start that one first. Then here, this is the green one is about a check deposit. Can you
Yes.
tell me how much is the check deposited but not credited?
The check was deposited for 9,000, but
Yes.
only 8,950 rupees was collected, I think,
Mm-hmm.
and 50 rupees was maybe discounted or something. I don't know. I don't know about that.
Mm-hmm. No, it's correct. It's not discounted. That's the difference. It has to be credited. Okay. Okay,
Okay. Okay.
Ashwika, you have to say something. Ashwika, tell me, Ashwika.
Sir, the balance 50 rupees, no sir.
Mhm.
Should we consider as a bank charges or like how should we consider that?
See, check is deposited for 9,000, but collection as per bank statement is 8,950. Okay.
Okay, sir.
Now,
So what about the
what you asked me a question is actually a thing. Practically, what happens, I tell you normally. Okay. Sometimes you have asked a very good and right practical question, right? Normally, what happens? Sometimes some companies they think that is a bank charges, right? And
yes.
this 50 rupees only because the amount is only 50 rupees and they account it as bank charges. Okay. But we cannot take ourselves anything as bank charge unless we receive instruction from the bank. Okay.
Yes.
So now we will try to solve it. So you see the 50 rupees is there. Yes, Somil has raised hands. Yes, Somil.
सर अगर ये बैंक चार्ज से नहीं कटा है तो फिर अपना 50 रुपीज माइनस हुआ, ये काय से कटा है, ये कैसे पता चलेगा?
No, check is deposited for 9,000. Still 50 is pending for credit. You will ask to the bank then. You show this bank reconciliation statement to the bank and you will ask. Then if bank, see, when bank gives a passbook, right? When bank gives a passbook, if it is a bank charge, bank should mention it is a bank charge. If it is not mentioned, we will assume that this 50 rupees has yet to be credited. Suppose the auditor also asks the same thing. Okay. Clear? Now, bills sent to bank for collection, collected by bank, but not recorded in the cash book. Now, bills for collection is actually 4,200. And it is collected by bank means, what do you mean? Bills sent to bank for collection, collected by a bank, but not recorded in cash book. What do you mean? Yes. Somil and Pranav, anybody can answer?
पैसे जो कि collection के लिए थे वो बैंक से कलेक्ट हो गए हैं, मतलब पैसे आ गए बैंक में, पर कैश बुक में अभी तक रिकॉर्ड नहीं हुआ क्योंकि
Right,
बिजनेसमैन
right.
को पता नहीं है.
Correct. Right. Absolutely right. So what happened is, बैंक को पता है लेकिन कंपनी को पता नहीं है. Yeah, Naina, you wanted to say something?
Yes, sir, the same answer.
Same. Thank you, Naina. Thank you. So bank charges which are recorded twice in cash book is 40. So bank charges recorded twice in cash book is 40. That means double times this is recorded in the cash book. So whose is this error? This is the error by whom? Cashier. Bank charges are recorded twice in the cash book. So the blue one is known to bank. Seventh one is the error made by the cashier. Noting charges debited in passbook for discounted bill dishonored. Now what happens? Whenever you have discounted some bill and it is dishonored, right? Then they will give some noting charges. So that noting charges is 60 rupees. Checks which are deposited on 25th March but collected by bank is on 5th April. That means it will come under check deposited, not credited, because on 31st March, it is not credited. So it will come under checks deposited, not credited. So this is coming to 4,800. Similarly, checks which are issued on 26th March but presented for encashment on 6th April. Yes. Somil, yes. What will come under? What will the 10th column come under? What will you tell them? What is the cause of difference for the 10th one? What will you name it? Yes, Somil, you have any doubt?
सर नोटिंग चार्जेस एक बार एक्सप्लेन कर देंगे क्या होता है वापस?
Noting charges means it is actually whenever a bill is dishonored, bank will take some dishonor charges. Like for checks, they take return charges, right? So in the bill of exchange, they say it as noting charges, and that noting charges is they have taken out, deducted 60 rupees from the company account. Okay. So the same thing is not known to the cashier. Now, 10th one, can anybody say 10th one will come under which type of error? 9th one is check deposited, not credited. 10th one is?
Sir, timing error.
What is that called? Timing error? What type of timing error?
Sir, late presentation. क्योंकि
Yeah.
सर
Checks-
बिल जो है वो अपने उसमें
checks issued but not presented.
Yes, sir.
Because checks were issued on 26th March, but presented for encashment on 6th April. So checks issued, not presented. Okay. Now what we do is, first of all, we have to check this cash book's unfavorable balance. Now in unfavorable balance, credit will increase and debit will decrease. Now what happens is, opening balance is 24,000. Cash transaction which is wrongly entered in the bank column, it is 3150. So actually it should go to cash. So 3150 will be reduced because it is showing an increase favorably. It will show a favorable type of transaction that cash is received by us, but actually it is a cash transaction, not a bank transaction. So then you have to do, there is a short debit. You took 1,000 for that, and bank charges which is recorded twice, you removed it by giving a, for that credit you gave a debit, and it is 40. So here, if anybody has doubt, just can ask me, because this is the way I have tried to rectify my cash book by taking these transactions.
सर स्लाइड शो नहीं हो रहा है। मैं एग्जिट करके फिर से आ गया, फिर भी शो नहीं हो रहा है।
क्या हुआ? सुनाई नहीं दे रहा है?
Slide not showing, sir. I have exited and entered because of network problem. Slide not showing for me.
अच्छा, फिर और एक बार लॉग इन करो, शायद हो सकता है. अदरवाइज टेक सपोर्ट विल हेल्प यू. Yeah, Gauri,
Okay,
anything
sir.
else?
So actually we mentioned to and by, but in this case we didn't mention.
No, this is, I am just showing you that what is increasing the credit and what is increasing debit, because I have not prepared the BRS. Before showing the BRS, I am telling you, this is your like a working note, so that you will not make any mistake while preparing the final BRS, because in the answer paper, you have to directly prepare the BRS, no? So for that reason, I am showing you that what can happen in the cash book, right?
Okay, sir.
That's
Thank
all.
you, sir.
Because, yeah, thank you. So what happens is, now when you are preparing, you have to prepare it like this. That yes, the overdraft as for cash book, then you will add this cash received from XZ entered in the bank balance, because this is credit balance again. It will increase your credit balance 3150. Similarly, check deposited but collected less as per bank statement. This will be 50 rupees, because then you go to the equation. That equation I have given you. You see, according to equation, if you do it, you'll make no mistake. So check deposited will be added to the cash book. So overdraft as per cash book, check deposited is added. Noting charges, bank charges will be added 60 rupees. Check deposited but collected by a bank on 5th April. That is check deposited and collected by a bank on 5th April. It is 4,800. It's like again check deposited. So you can see here, I have given the T20. So if you follow that equation, this is how you are getting your. So if you follow that equation, particular equation which I have given you, definitely you'll be reaching your answer. So that's why this question is 5 marks. This question is 5 marks, because you have just to prepare a bank reconciliation statement as on 31st March. So this is your recent June 2024 foundation question. Okay. So just if you check the equation and accordingly, according to the equation, you put one, only thing is you have to just correctly classify the causes of difference. Once your classification is correct, then your equation will be correct and your answer will be 100% correct. Okay. Any doubt here? Okay. So then what you are giving, this is the plus side you have given. Less side, what we will give, check deposited but not recorded in the cash book. Okay. So what happens is the check is deposited, but it is not recorded in the cash book. So that will reduce the balance actually, because it is not known to the, it is like a bank receipt, which is not known to the cashier. So since it is not known to the cashier, not recorded, you are adding it. Debit side of the bank column, cashed short. Now, which is debit side, which was cashed short, is like a bank receipt, you know, it is cashed short, and you have that 1,000 which is there, it has to be deducted because it is taking excess as a deduction. And bills for collection created in the bank but not entered in the cash book. So known to bank as a bank receipt. It's a bills for collection, known to bank as a bank receipt. So your equation is saying minus the bank receipt. So you are deducting it. Bank charges recorded twice should not be recorded twice. We have done a mistake. Cash book has done a mistake of recording it twice. So it is deducting it. Then finally, you are, as per the equation, you are minus the check issued but not presented. And you are getting a overdraft as per bank passbook. So this is the, you see, a question of 5 marks and you got the final balance. Yes, Pranab, tell me.
सर वही है, मतलब स्लाइड शो नहीं हो रहा है.
Okay.
एक
I would
बार
request the tech support to once. I think others are able to see the slides. Is the slides visible?
Yeah,
Gauri?
sir, visible, sir.
Yeah. So
Yeah,
Pranab,
sir, it's visible.
visible. Okay, thank you, Gauri. So Pranab, please once check at your end network connection, or if you want, or if you see, check it through mobile. If you can connect it through mobile, okay. So this is another question. The last question I am solving it from December 2023. So here what happens is you are preparing a bank reconciliation statement as on 31st December 2022. Here it is a 8 marks question. Now that was a 5 marks question. This is a 8 marks question. Now it is showing bank overdraft. Now the moment this passbook is overdraft, just remember the equation which is going in your mind. Overdraft passbook minus definitely it is asking you to prepare a BRS, means you have to reach to overdraft cash book. So that means overdraft passbook minus check deposited plus check issued minus bank charges plus bank receipts equal to overdraft cash book. So this is the way you remember that equation, or you can write it down in your working side of your notebook. Then checks issued 2,10,000, but only 1,40,000 were presented for payment. That means you will get here check issued not presented. Check drawn for payment of telephone bill has been entered in the cash book as 29,200, but was shown correctly in the bank statement. Now, whose error it is? Yellow is for the error. Whose error? Yes, Somil. Somil will say.
So businessman.
Businessman error. Very good. Because telephone bill check, bank has done it correctly. Cashier has done it incorrectly. Then check receipt for 37,520 entered twice in cash book. That means this is also the error by the business only. Check of 1,17,000 issued for purchase of merchandise and was paid by the bank, but it is not recorded by the cash book. Now here what happens is, this is like a bank charge, 1,17,000 check was issued and the same thing is not recorded in the cash book. So this is the thing which is done by the bank but not known to the cash book. Okay, Naina has some doubt, I think. Yes, Naina?
Yes, sir. I was asking that the point number 5 is an error of omission or error of transaction.
If you see in the light of this adjusted cash book, then it is actually an error of omission. Because
And if
you see what happened is, it's an error of not a transaction, not a bank transaction. Because what happened is the check is issued for purchase of merchandise. It is paid by the bank also, but the cashier has done the error. It has not recorded in the cash book. Okay. See, you have issued a check.
yes, sir.
That means when you have issued a check, you should have noted it in the cash book. Correctly?
Yes, sir.
But you have not done that. So when the cashier has not done that, yes, Ashu, what is your doubt? So that is, it's not like an omission that it is a bank statement, but actually the cashier has done it. Ashu, you have any doubt? Now, you can see the 6th point. Interest on overdraft and bank charges were not entered in cash book. So interest on overdraft and bank charges, 3,500 value, that is not entered. So the same thing is known to bank, but not to the cash book. Checks credited in passbook, but was not recorded in cash book. It's again a bank transaction. Bill of exchange, dishonored. So they're saying no entry made in the cash book, but it's not an error because cashier doesn't know about it. 26,020 discount. Payment share of the cash book has been undercashed by 12,000. So now what we are doing is, we are going from overdraft bank book to cash book. So what we'll do, we'll rectify the errors in the bank side and we'll accept the errors in the cash side. Then only we can reach to the cash balance. So you can see it is the 8 marks. So debit balance, what you did is you added all the checks issued but not yet presented for payment, because the request is overdraft passbook balance plus check issued. So 2,10,000 minus 1,40,000, 70,000 you check wrongly entered in the cash book. You see, check wrongly entered 29,200 minus 19,200. So 10,000 error has been made by the cash book, and you are accepting that error. You are adding it back because your passbook is correct, but you are now reaching to the cash book. So you are accepting that error and going to the cash book. Check credited in passbook was not recorded in cash book. So again, it is coming like a bank receipt, which is to be added as per our equation. Less check receipt entered twice in cash book. Now, yes. Ashu, you want to say something? Check is received and entered twice in the cash book. So that means what happened? You have entered it twice. So what happened now in the cash book? This error has to be taken because you're going to the cash book. So you're reducing the overdraft balance by recording that cash of 37,520. Next is check which is issued but not recorded in the cash book. Now the check is issued and not recorded in the cash book. That means you cannot take that 1,17,000 as your increase in overdraft balance. Rather, you have to decrease your overdraft balance by 1,17,000 because you have to accept the error which has been committed by the cash book. Yes, Somil?
सर अभी दो
Yes,
पेपर देखे, एक जून का और एक ये
दिसंबर
तो
का.
सर वो जो था वो 5 मार्क्स का था, ये वाला 8 मार्क्स का है, तो डिफरेंस की कोई खास वजह है इसमें?
See the number of points here and the number of points there. There were only 5 points. Here more points of causes of difference are there. Okay. And moreover, here the questions are asked if the number of errors are more. So your rectification requires more effort. It will take you a longer time to solve this one than that one. Clear? You can check it, both of them. You can see the number of differences, cause of difference are more there. Now, less here is interest on bank overdraft, bank charges, as you know, we have to deduct it. So, bill of exchange is dishonored. It's like a bank charge. Payment side of the bank column of cash book was under cash. Now, payment side is under cash means payment side is shown less. So, here also we'll deduct it because we accept that cash book error. And finally, we got the overdraft as per cash book. So, I hope there is no doubt here. You're clear on this. What it needs is a lot of practice on this. Take that 2 equations of favorable and unfavorable balance, take a printout of it, keep it in front of you, start practicing your all these foundation question papers. You will see that you are getting all the answers. Okay. So this I leave it to you once you practice it and come back. So that this is the same thing here. Yeah, Aman, what is? Yes, Aman, what's your doubt?
Hello, sir. I had to ask, there are 2 methods to solve VRS through this addless method and plus minus method. Sir, which would be more appropriate to use?
Balance presentation will be more appropriate for you all. If you are comfortable in plus minus, you can go ahead with it. Or normally plus minus, if you are in a shortage of time, you may commit error. If you are so perfect, you can go for plus minus.
Okay,
But the best thing is, while preparing BRS, you write that we are preparing under balance presentation method and write this. Okay.
Sir, why there can be error during plus minus method? I mean, I've solved a lot of questions through that method too. I haven't found.
You can go. No, it's not about your error. I am talking about the comfortability of the candidates. Okay.
Okay, sir.
Okay. So this I have solved it. The slide is there. I have shared it to you. Once look into it and solve it. Yeah. You have any doubt here, Sohana?
Sir, small doubt is when we solve with the normal balances, when it comes to the unfavorable balances, it would be having an opposite effect of the favorable balances while solving the problem.
Yes.
Okay,
So
sir.
you need not think about this opposite effect. You think about the equation for the unfavorable balance, what is given, and solve accordingly.
Okay, sir. Thank you.
That way you will relieve the confusion. Okay, yes. Somebody from Samsung Mobile. Yes, what's your doubt? I think he's not able to say. Anyways, I think once you practice it and come back with your queries in the next class, let me take a 10 minutes break and we can start inventories. Will it be okay? We'll start inventories at 12. Okay. Fine with all of you? So thank you. I'm just stopping the share. I'm just stopping my video. After 10 minutes, we will start inventories, which is the next session. And it's also a very, very important session because you get a lot of questions and you have to properly make again, there also, I will tell you the trick how to solve it. Okay. Inventories. So we will come back after 10 minutes. But my request is please solve this bank reconciliation statements. Come back with doubts. Come back with doubts from the study materials. The more you practice, the more you will definitely make it perfect. Definitely. It requires the journey to success to see a foundation is through hard work. That's all. So it requires an hard work and effort from your side. Okay. Thank you. So we'll come back after 10 minutes. So is it visible to all of you? Is it visible? Okay, thank you. So what happened is, as we start on this study on inventory, one of the major current assets in the grouping, the treatment of inventory is one of the crucial topics in your accounting. So we will start on it with it, and the next subsequent 2 classes will be on the inventory only. So what are the topics will be covered in the syllabus as per CA Foundation, according to CA Foundation? First of all, we'll understand what exactly is the inventory, the meaning of the term, what comes under inventory. Second is, what is the techniques of inventory valuation? How will we value the inventories? Then how the records of inventories, as inventory is a very big chunk of large component of your accounting. So how will you keep your inventory, right? What are the methods of recording or keeping track of your inventories? Yes, you wanted to ask something? Okay. Then what are the intricacies or what are the complexities related to the inventory taking? Yes, Suhana, anything?
Sir, regarding to this topic, like how much marks of questions would be asking in the exam, sir?
Yeah, it is a bit more marks. We will discuss on that. How many marks? There will be short questions, long questions, how it will be. Okay, we will discuss all of this in the subsequent classes, surely. Okay.
Okay, sir. Thank you.
Now, when we go to the types of inventory, this I think you have all studied in your previous, classes, academic classes. Manufacturing concerns, inventory you classify into manufacturing and trading. Why? In trading, you simply trade goods, purchase it from somebody and sell it to somebody. But in manufacturing, it goes entirely through an engineering and technological process so that the raw material first turns into semi-finished or work in progress. Then work in progress transforms into finished goods and it gets ready for sales. Apart from that, manufacturing concerns are usually large industries, so there will be stores and spare materials also that they comprise inventory. Secondly, since these are produced in bulk, they produce in bulk because manufacturer will give it to the wholesaler, wholesaler will give it to the retailer. So there's an entire process. So for that reason, in this merchandise, packing material is also one of the inventory, and they are also kept in huge numbers, packing materials as a inventory specification. So this is how your manufacturing and trading concerns, the inventory has been classified as the types of inventory. Yes. Suhana, you have any doubt here? Yeah. Then what happens is you are trying to find a basis of inventory valuation, right? How are you valuing inventories? Okay. Now there are 2 bases of valuation. One is cost and another is net realization value. And out of that, whichever is less, because you are following the principle of conservative accounting. So you will take which one is less, you will take that value. So this is what is one of the essential part. And for that, this is one of the main portion of the inventory valuation. And we'll be discussing about what is the cost and what is the net realization value. Now, what is the cost? Just look into it. If you look into the slides, what is the cost? Inventory costs are 3 things mainly. One is a cost of purchase, another is conversion cost, how to convert this inventory, and another is, last one is, which are the costs which are incurred in bringing the inventory from one location to the present location, say the warehouse or inside the factory, present location and condition. Now we will first see what is this cost of purchase is. So all the purchase price, duties, taxes, whatever freight inwards is coming with that, normally whatever is mentioned in the supplier bill, expenditure which is directly you can attribute it to this cost is the cost of purchase. And what you subtract from there, any trade discounts, it will not be the cost of purchase. Trade discount, because you get a discount on this, so it will not be a cost of purchase. rebates, duty drawbacks, because you will not pay for that. You are getting exemption for that. So they will not come under the cost of inventory. So suppose imagine that a raw material cost is 10,000. You put a GST at 18% is 1,800. And your total cost is 11,800. Now, GST and purchase is available as credit. In that condition, where cost of purchase will be 11,800 minus 1,800, 10,000. So this is actually your cost of purchase. So these are the things which we should keep in mind. Small things, but we should keep in mind these concepts while solving the problems. Cost of conversion. Normally in the manufacturing sector, raw material gets converted to finished goods. So 100 units of raw material will be converted into 100 units of finished goods. So in that condition, what happens is, suppose some direct labor is involved. All the direct costs which are directly attributable to this product is added here. So the direct labor cost of 3,000, which is directly related to units of production, is your cost of conversion. Then what is the other costs? Other costs, suppose a truck is going to the warehouse, okay, and your unloading charges for the truck which goes to the warehouse is 200 rupees. So that 200 rupees is a cost specifically incurred to bring the inventory into the present location. So this is coming under the other costs. So total cost of inventory, if you take, first of all, you take cost of purchase, which you get 10,000. Then you take cost of conversion, direct labor cost, which is 3,000. Then you take other costs, which is unloading charges, 200. So your total cost comes to 10,000 plus 3,000 plus 200 is 13,200 is your total cost of the inventory. What is the exclusion? Now, when I'm talking about cost, what we will not include it? First of all, abnormal wastage, because this is not linked to the operations of the company. It is accidental. Samanth, yes. Samarth, yes, your question. Yes,
Sir, in last slide, that unloading charges are the unloading charges of raw material.
This normally raw materials. Because
okay, so
I am talking about a manufacturing company, right? In a manufacturing company, what happens is raw materials are issued. We ask the suppliers to give us raw materials, so they send it through freight. Now, what happens is now when it comes to the factory, you have to unload it to the factory gate. From there, you have to unload it. So for that, you require labor because they come in bulk. Okay, clear now?
okay, sir. Thank you.
So similarly, apart from abnormal wastage, it is an accidental. Storage cost, suppose you're keeping the inventory in the warehouse, like you're giving a rent, those storage costs are not included in the cost of inventory. So they are not added to the cost of inventories there. Then similarly, some administrative overheads, administrative people working on something, total supervisory work. So this is also excluded from the cost of inventories. Then selling and distribution cost, because now what happens once the inventory is there, it's produced, finished goods is there, you are trying to sell it, you are trying to market it, comes under marketing expenses, but these are never a part of the cost of inventories. So try to understand that these four are not a part of the cost of inventories. So we have to keep in mind these things. Then we have to just understand what is the net realizable value. You are realizing it value, but then there is a net realizable value. Now, what happens is whenever any traded goods just to purchase and sell or finished goods, you have a selling price. But for selling that goods, you have incurred some sales and distribution expenses to sell that good, to attract the customers, to bring the customers to take a product that is a good quality. So in that condition, your selling price from there, it is deducted sales and distribution expenses. So for finished goods and traded goods, selling price minus sales and distribution expenses comes under net realizable value. If you go to work in progress, what happens? Same selling price which is attached to this work in progress, whatever value they are ready to take, minus the expense and overheads of conversion. That expenditure which is required and that overheads which are involved to convert this work in process from the raw material to work in process, that is deducted from the selling price of the work in progress. So this is the net realizable value. Yes. Yeah, Sohana.
Sir, what is this overhead of conversion means?
Overheads, see, you have suppose 5,000 supervisors, right? These are overheads. Out of the 5,000 supervisors, 500 are involved in this monitoring this work in process, raw material to conversion of work in process. So this salary of those 500 will be included in the expense of conversion. Correct?
Okay, sir.
Okay. So,
sir, but in the previous point, you told that the administration overhead cost will not be a part of calculation of inventory, sir. Then, I mean, what is the difference
no,
between
this
that
is,
overhead?
I am talking about this is net realizable value. See, once
Okay.
I find net realizable value, I have cost figure with me. I have net realizable value with me. I have to see
Okay.
whichever is lower. I have to value inventory accordingly. Okay.
Okay, sir.
Okay.
Thank you.
So for the raw materials, normally we talk of the replacement cost on raw materials because we think that the raw material, if this raw material has to be replaced, if you get another raw material, what is that cost from the market is net realizable value. Because what happens is in the factory production, practically what happens, normally the raw materials which are issued at cost and you normally sell at a higher cost. And if the market demand is there, then your material is gone for a higher cost. Now what happens? Suppose some problems happen, something war happens, some outbreak happens, like a COVID pandemic happens, somewhere the cost price, the market value of the product may decrease. In that time, it becomes necessary, suppose, to calculate the net realizable value. So you go for that. Now, in the raw materials where they are in bulk, you go for the replacement cost. Yes, Pawan?
Sir, I just wanted to ask that overhead of that conversion was there. Are all those indirect expenses?
Yes, your overheads, which is that linked to the, just I'm showing here, expense and overheads of the conversion, which are linked to the conversion process, expense and overheads, both are included in the net realizable value. We are trying to calculate the net realizable value. As I said about cost, in cost, you are classifying as direct cost, indirect cost, like that. In net realizable value, you are just calculating the net realizable value, right?
Okay, sir. Thank
Okay.
you.
Yeah. Suhana, you have a doubt?
Sir, like why we won't include the rent in that calculation of this inventory, sir?
Yeah, we can include rent. See, we never, it's not that we never, it's that mostly we don't include rent unless it is given specifically in the question. For example, now this goods which is kept for a longer period of time to produce for another goods, that time the rent becomes a cost. If that storage is required so that you will produce another material, that
Okay,
time
sir.
you include the rent. Otherwise, you don't include. Okay.
Okay, so I mean, same thing goes with the selling and distribution cost also, sir.
Selling and distribution is never included because it is a part of a marketing expenditure. Because the moment it is selling, means the selling price comes in the picture, not the cost price.
Okay, sir. Thank you.
Okay. So we'll be solving problems. So we'll be getting to knowing all these things.
Okay, sir. Thank you.
Now, inventory record system, right? Once you know about the cost, net realizable value, how you record it. I think you'll have studied it, but still I'm just giving a brief glance on this. What happens is there is something called periodic inventory. Normally, small enterprises do it. Small purchases, they do it, and they can keep track of the inventory. They can control their inventory. So what happens is the opening inventory is normally known because it's the previous balance. Purchases through the bills and everything, they get it known. So what happens? They find the closing inventory by physical counting. Because since a small company, they can count it, they can control the inventory. They do a physical verification, physically count it, and they found the closing inventory. Then what they do is when they find it, then they can get the cost of goods sold. This is how the periodic inventory system happens. Now consider that if there's a large company, there's a continuous flow of goods, it's a big process industry, that time you are going to a perpetual inventory record system. Now in a perpetual inventory system, what happens is you have the open inventory, which is known to you. You have purchases also during the period is known, but physical verification becomes an impossibility at that time. It's or very hectic, and that time you what to do is you also keep track of cost of goods sold. You also keep track of cost of goods sold because normally this amount is smaller than the closing stock, which is the balancing figure. So normally this amount is smaller. So practically, you in the perpetual inventory system, actually closing stock is the balancing figure, and you know the cost of goods sold. Okay, so this is the difference between the periodic and the perpetual inventory system. Now we will go to the historic method of stock valuation, which is important for your problems. historical method. Why it is known as historical? Because you are taking the past data, relying on those past data, and you're thinking you're valuing your inventory. Why you value your inventory? Your valuation of inventory needed, because one of the things is inventory is one of the asset in the balance sheet, and moreover for calculating the gross profit, you need to value your inventory. So for that reason, there are several methods to value the inventory. One is specific identification method. You have 3 items. You know the historical cost, you know the net realizable value, and you have to find out which one is lower of them, of all the 3 items. Now in item P, 38 is smaller than 42. So you take 38. Item Q, both are similar. So you take 29. Item R, 17 is greater than 14. So NRV is higher. So you take the 14 one and you get the total 81. So this is a historical identification method of valuation of inventory. But as you all know, most popular is the FIFO, LIFO, and simple average method. And Indian accounting standard, after IFRS has been trying to, India going towards the IFRS journey, FIFO, LIFO, and simple average method is one of the most discussed methods for inventory valuation, mostly FIFO and LIFO. And you all have, I think, studied FIFO and LIFO also. FIFO is, you all know, first in, first out, and LIFO is last in, first out. Now, if you see to FIFO, you can see here how we are solving a FIFO here. Units you have received means it is purchased on 10th January, on 15th January, and some 500 units at 50 rupees, at 60 rupees. But when you issued it for sale on 20th January, it is 500 units. So at that time, what happens? When you are doing a FIFO, you have to take that first in, first out, means 10th January, whichever units have received, they should go out. So 10th January, 500 units gone out of the factory premises. So what is remaining now? The closing stock is that stock which is remaining in the factory, 500 units at 60 rupees. That means the most recent price becomes the closing stock. And the previous price, first in, first out, is gone because it is purchased first, it should go away first. But if we see a LIFO method, there's just a reverse, because the last in is first out. The 500 units, which is at 60 rupees on 15th January, they've gone out of the premises, but that 10th January units are still in the closing stock. So 500 units at 50 rupees, 25,000. So you see, FIFO closing stock has increased 30,000. In LIFO, the closing stock has decreased, is 25,000. So normally, if you don't want to go into this and you try to have a simple average method, yeah, Shivana. Yes,
Sir, can we say that LIFO, FIFO, and simple average method are types of NRV?
Type of?
NRV, net realization value.
No, they are not net realization value. This is type of inventory valuation. Okay. Net realization value comes into picture when you try to sell the inventory.
Oh, so sir, there are 5 kind of 5 ways to value the inventory.
See,
Cost, NRV, LIFO, FIFO, and simple average.
Whenever I am writing all this, you see I am writing the cost only. So the basis of assumption of this inventory is through cost only, not through the selling price.
Oh, sir.
Okay.
Okay.
So now simple average is 60 plus 50 by 2, 55. So you got the closing stock for 500 units at 50 rupees. You got 27,500. Now let us, when we see these methods, let us try to see how it goes on. Normally, practically how they write in the books of the inventory, how they maintain inventory register. First of all, opening inventory is nil. Purchases has been done 100 units at 30 per unit. Out of those 30 units, out of this 100 units, you have issued for consumption 50 units. So on 15th January, you have issued for consumption 50 units. And on 1st February, you again purchased 200 units at 40 rupees per unit. But again on 15th February, you issued again for consumption from those total lot 100 units. And 20 again you select 100 units. Now, what is the method of valuation? if you adopt a FIFO method. So your table becomes like this when you write a date, receipts, issues, and balance. Okay. And how the balance comes? Receipts minus issues is the balance. Every unit is written, the rate is written so that you get the total amount of the inventory. Starting, you purchase 100 at the rate of 30 rupees, you got 3,000. No issues has been made. So 100 into 30 is 3,000. Next, what you did is you issued 50 at the rate of 30 rupees, become 1,500. So the balance is now out of 150 gone, issued. So rest 50 remained out of 100 minus 50. So your 50 and 30, it become 5 into 3. Again, it became 1,500 is the balance. The balance became 50 into 30, 1,500. Next, in 1st February, you took 200. You took 40 rupees at the rate 40 rupees. You gave 8,000. You got 8,000 you purchased. But the balance now is 50, 30 earlier 1,500, 200, 40 is 8,000. So now no issues is made. So as on 1st February, if you see, the balance remains the same. If you go to 15th February, what we get is 50 into 30 is 1,500. So 50 units, you have got it from the 100 units which you have earlier did, because it is first in, first out. So you took this 50 which is earlier there. So the first 50 has been used here, and you got 50 into 30. 50 into 30 is 1,500. Next 50, you again get it from 200, because our problem was on 15th February, we issued 100 units. So 50 units from the first 100 lot, and then you take 50 from the next 200 lot. So what you get? Yes, Pawan. Yes, Pawan.
Sir, are we going to go through only FIFO, LIFO, and simple average method?
Yes. What happened?
Are we going to study only these 3 methods?
No, we are going to study more. The class has started. We have to be patient. Okay.
Okay, sir.
Just as yeah, Gauri, I will answer your query. Just a second. Gauri, yes. Gauri wants to say something. Yes.
So here issue means sales, sir.
Issue?
Issue means sales, sir, here.
Issue means consumption only, sales.
Okay, sir. Thank you so much.
So, Ashu, you have a doubt? Ashu, what's your doubt? So what happened now that you got from 150 units from 200? Okay. Yes, Aman.
Sir, the data being mentioned here in the table is quite confusing for me to understand. Can you explain it once more?
Which data?
Sir, from 15th of Jan to here 15th of February we have come. Yeah, between these the data being mentioned all.
Okay. Aman, now I want to ask you, 1st February, what happened? See the table and say in the receipt column.
Sir, on 1st February we received 100 units at the rate of 30 rupees.
1st February, check it properly. 1st February. I'm
okay,
not
1st February here. We received 200 units at the rate of 40 rupees.
Yes. So how much 200 into 40?
It is 8,000.
Okay. We received that much. Okay. Now, if you see, what is the balance now remaining?
So it is 15 units being remaining from the year. So here I'm being confused. Why it is written 15 into 30?
Yeah,
That's what I was
because
asking.
unless you made a purchase
Yeah.
What is the, from 1st January to 15th January, you tell me what is the purchase price of the inventory?
It is 13 rupees.
13 rupees.
Yeah.
13 rupees, 13 or 30?
30. I
30
said it is
rupees.
a,
So you have to record it at that purchase price only, because you have not purchased any other inventory till now.
yeah.
Correct, no?
Okay. Yeah.
Yeah. Because this is all, you require practice also to do that. Then
Oh,
1st February, you got 40 rupees.
yes,
Right?
sir.
New price is, the inventory now is available at a new price of 40 rupees. Okay. So what happened
Yes,
now?
sir.
Earlier you had 50 units at 30 rupees, and now you added it to it. New stock, fresh stock of 200 at 40 rupees.
40
Which is
rupees.
8,000. Correct?
Yes, sir.
So what you have the amount now? 1,500 of previous stock plus 8,000 of fresh stock.
Press
Yeah.
stop.
Okay.
Yes, sir.
Okay. Then
Got it.
at 15th February, what you have to do? How many units you have to issue?
We have to issue 30 units.
No, 15th February. Question is given. 15th February. Previous question.
Yeah. We have to issue 40 units and
No,
this
15th
30
February.
units.
If you have
Yeah, I'm
written
seeing it
down
15 February.
15th February, what is written here? Issued for consumption. How many units?
It is 100 units.
100 units. So previous units had 50 units with you. Can you issue 100 from
Yeah.
the 50 units? Is it possible?
Yeah, yes, sir.
How it is possible?
We can,
Previous stock of 30 rupees had only 50 units. How it is possible from 50 units to get 100 units? Then
sir,
what
we
can you
will issue 50 units from the previous stock, and we can also issue and the next 50 units from the fresh stock.
Very good. So that's what I was telling you. Now you see 50 units from the previous stock and 50
Yes,
units
sir.
from the fresh stock. Right?
Fresh stock.
So 50 units from
Right.
100 and 50 units from 200. Clear now?
Yes, sir. Clear.
So your issue is now 1500, 15 to 30, 1500, 15 to 40, 2000. This is your old stock is now completely gone, because first in first stock means you should completely wipe out the old stock. You should start from the old stock. Okay. So first
Okay,
who came, they should go out first. Last who came, they should go last. So first in, first out. So 50, 30, 1500 gone. And the next 50 is from 40 rupees inventory. That's the first stock. So it is 200 minus 50. Now the balance is 150. So 150 into 40 is 6,000. Clear, Aman?
Yes, sir. Clear.
Okay. Then on 20 February, the old stock is already gone. What is remaining is the new stock, the 200 rupees of 40 rupees. So 100 rupees into 40, it is 4,000. When it's gone, your balance is now only 50 rupees. So 15 to 40, 2,000 rupees. So this is how you are getting the valuation of inventory under the FIFO method for the description I have given in the question. Clear? Now we will go to the weighted average method. What do the weighted average method do? So we have talked about simple average. You all know LIFO. We'll go to the weighted average. Same table, same type of situation is happening. Okay. I'm just showing what happens in weighted average. Unless you issue something, you have what we observe here is till 1st February 2022, you have 50 units at 30 rupees and 200 units at 40 rupees up to 1st February 2022. Now what happened is you have not done any issues till now. After the previous issue, from the fresh, there has not been any issue. So what we do is the number of units there with you is 200 plus 50. You add it. And 30 rupees and 40 rupees are the prices. So you add 50 into 30 plus 200 into 40. Okay. So now we are going to divide this. So, and that will give us the value of the inventory at 50 rupees. So what we do is 1500 plus 8,000 is 9,500. 200 plus 50 is 250. Weighted average price becomes 38 because it is weight according to the lots. And then your value of inventory is now 50 units at 38 rupees, 1900 rupees. Okay. Yes. Sohana Sen.
Sir, once again, can you repeat this weighted average method?
Okay, sure.
Thank you.
Okay. So what happens here is in the weighted average, before I start here, now, Suhana, let us see. I'm just telling you, can you see any sales between 1st February to 15th February?
1st February to 15th.
Any sales you are seeing in the table?
Sir, on the 1st of February, I guess so.
1st of February, what is the sale you are seeing?
Sorry, sir, no sales, sir. Sorry.
No sales.
No,
So
no.
now you will take these two prices to calculate your weighted average, correct?
Yes, sir.
Okay. That is the prices are 30 rupees and 40 rupees. Okay.
Yes, sir.
Because no new sales have come now. Now what happens is you have got 200 units. Okay. And you have also got 50 units balance because the last previous stock 100 if you, out of that you had only 100 units of stock. So when somebody asked to issue, what you did out of 100 you gave 50, correct or not?
Yes, sir.
Because that time 200 didn't came. So when somebody asked on 15th January, I want 50 units for giving it to a customer, what you did from that 100 units, you took 50 units. Okay.
Okay, sir.
Okay, so what happened? Now this 50 units, when you took it, after that the balance remained is rest 50. Okay.
Yes, sir.
So the balance, this 50 and this 200 is totally 200 plus 50. 250 is the balance remaining. Okay.
Okay, sir. Okay.
Now we have to take the prices. 30 rupees is for this previous stock. 40 rupees is for the present stock. And what you do is multiply all these balances with that unit prices.
Okay, sir.
Okay. 50 into 30 plus 200 into 40. And we have to find the value for this 50 rupees on 50 units on 20 February 2022.
Okay.
20 February 2022, this 50 which remain, we have to find that balance. What is the value of that weighted average price? So what we did is, we just divided it.
Okay.
And what price we get, we attached it to this 50 units. So our value became 1900.
Okay, so like the last remaining 50 units that has been multiplied with the value which has come from the weighted average price.
Yes.
So that would be multiplied. Okay.
Yes, because here we are not following a FIFO method. So we have to find an average price which we can fit into it. Okay. In simple average, what we're doing, we are just doing the average. But in weighted average, you have to take the weights according to the number of lots.
Okay. So like usually in what scenario does in the practical life? So when these weighted average price is mostly used, sir?
No, weighted average you are particularly you are using where you know that yeah, I have this much small amount of inventory, my issues is less. In that you use weighted average. Okay. And normally inventory accounting suggests for a FIFO method, as you all know. I think you have studied all of this.
Okay, sir.
Indian accounting standards, they advocate for the FIFO method. They advise for the FIFO method. Okay.
Okay, so like whenever the quantity is very less, which is almost equal to minimal quantity.
And you don't have you normally there's no way to follow. There's no such hard and fast rule to follow a regulation. Or you want it for just internal control to see how the items are moving. Then you can weighted average. Normally, what you can do, you can do it in a periodic basis, as a quarterly basis. You can do a weighted average to know your inventory position also.
Okay, sir. Understood, sir. Thank you so much, sir.
So now we will go to the another method, which is known as the non-historical cost method. Now, what is the non-historical cost method? Why it is known as non-historical? We just now talk to historical. We'll go to non-historical. Just give me a 5 minutes break. So as we know that this name indicates non-historical cost method. What is happening is here, we are going through an adjusted selling price method, also known as the retail price method. Why it is known as non-historical? Because at present situation only, we are trying to evaluate the cost. We are evaluating the cost according to the current conditions, not that how many were purchased earlier, how many were issued earlier. All these we are not taking into account. We are just taking the particular at the present, what is the situation of the inventory, what is the status of the inventory. Accordingly, we are trying to find the cost. So how we are doing it, what they are actually doing it, let us understand it. So you all know this. I think if you have any doubt here, ask. I'll be specifically telling you, because here, if we do not understand this part, it becomes confusing for us to understand the adjusted selling price method, which can be a question always in the exams. Now, this you all know. What is gross margin? What is gross margin? It is gross profit only, right? So all of you know, I think this rate of gross margin is actually, or gross profit is gross profit divided by sales. And what is your cost price? Gross margin is sales price minus cost price. So cost price equal to sales price minus the gross margin. So if you deduct the gross margin from the sales price, definitely you are getting the cost price. And then what happens is, you can also calculate gross margin as rate of gross margin into sales price. So if you want to find gross margin, you have the rate of gross margin with you, and you have the sales price with you. You can also calculate the gross margin. Now, suppose you have rate of gross margin, you have the sales price, but you don't know the cost price, at which price it was purchased. Then also you can find it. That's why I'm saying it's non-historical cost method. You are at that particular moment, you are finding the price. So you find it sales price minus, you multiply the rate of gross margin into the sales price, you get the gross margin. So cost price equal to sales price minus gross margin. So that means, again, you are coming to the same scenario. So if you want gross margin, you can multiply the rate of gross margin into sales price, provided gross margin is given. Otherwise, if you have sales price, gross margin, and you want cost price, you can use the classical formula of sales price minus gross margin, and you can calculate it. I hope here there is no doubt. Okay, Aman? Yes, Aman, tell me.
Sir, explain gross margin once. I'm quite confused here.
Which one? Gross margin?
Yes, sir, only that, sir.
What is gross margin? Can you tell the formula of gross margin first of all?
Sir, I don't know. That's why I'm asking.
What is profit?
Profit is the margin we get after selling our goods.
So what is the formula for that? If we have studied in 10th class.
Yes, sir. Yes, sir. That the formula is sales price minus cost price.
Right. So that profit is known as a gross margin here, because in companies, after selling the goods and the cost incurred in it, there are some other expenses of the company which are known for preparing the profit and loss account. So have you prepared a trading and profit and loss account?
Yes, sir. I don't completely remember that, but yeah, I have done once.
Yeah. So in the trading account, why they see it as a gross profit? Because you simply get the profit from purchasing and the selling of goods. And after that, when other expenses come, you come to the net profit, correct?
Yes.
So since
sir,
you now,
can we conclusively say profit is all related to gross margin?
So gross profit is your gross margin.
Okay, I got it.
It's not the net profit. Okay.
Yes, sir.
And neither is the profit after taxes, because we are not using any taxes here. We are just simply finding the gross profit. Okay.
Okay.
So now it's clear, I think. So you get the gross margin if you want. You find rate of gross margin into sales price, and for cost price, you get sales price minus rate of gross margin into sales price. So this is how we are approaching out here. And now how to use it in this sales adjusted selling price method. Now, what happens is, how we find in inventory the gross margin? First of all, you have to find out, you have to know what is the selling price of goods available for sale. Goods available for sale. So goods sold and goods available for sale are two different things. Goods sold means already gone. Goods available for sale is they're ready with the warehouse. Just they'll be ready for sale. And the cost of those goods available for sale will give you the gross margin. As simple equation as that. So gross margin is selling price of goods available for sale minus cost of goods available for sale. So what is the rate of gross margin now? It is gross margin divided by the selling price of goods available for sale. So once you calculate the gross margin, you can also get the gross margin. Any doubts here? Okay. Then suppose you want to find the cost of the closing inventory. What is that cost? So you have the selling price of closing inventory minus the unrealized profit on the closing inventory. What happens is you do not have the cost of that closing inventory. You know that this is the price at which it is being sold. So when this is the price at which it is being sold, it will be sold. Now this selling has, if it will be sold, then you will get profit. Unless it is sold, it is an unrealized profit. So from the selling price of closing inventory, you have to deduct the unrealized profit, which is still inside or which is embedded in the inventory, and which is due to which it is showing a selling price. So from the selling price, when you deduct the unrealized profit, you get the cost of the closing inventory. So your adjusted selling price method uses this type of method instead of this historical cost valuation to do it. Yes, Somil. Yeah, Somil.
सर जब कॉस्ट ही नहीं पता होगी तो अनरियलाइज प्रॉफिट कैसे पता करेंगे?
Say, like you have inventory in so many bulks, right? Selling and purchasing are going. In retail trade, what happens? There are all similar type of items. Okay. Are you getting it? Okay. We'll be solving a problem for you to know it. Suppose we are having a bulk of items and we are selling and purchasing, everything is going on. Now, in such bulk of similar items, your gross margin is constant. Are you getting it, Somin?
Yes, sir.
Yeah. Are you getting it? Now, when the gross margin is constant, suppose you have kept a gross margin of 20% on sales. So now that gross margin will be used to calculate the cost of closing inventory.
Yes, sir.
Okay. Now, what we do is, yeah, Ashu, I don't know why Ashu is not able to speak. He tries to ask, might be facing some network problem. Okay. Now we have the cost of closing inventory equal to the selling price of closing inventory minus rate of gross margin into selling price of closing inventory. Now this rate of gross margin into the selling price of closing inventory is giving me the unrealized profit which is inside the closing inventory. So then if you want, you can take a snapshot of this. Remember this formula for the calculation of the adjusted selling price method. So what happens? You have got sales. From the sales, remember this flowchart. From the sales, you have to go to the closing inventory at selling price. So how will you reach it? You add the sales to closing inventory. Then you get the cost of goods with the sales. When you add the closing inventory at selling price, you get the cost of goods which are available for sale, because you have the sales price, number of goods sold. You know the closing inventory at selling price. You add up both of them, you get cost of goods available for sale. From the cost of goods available for sale, you go to the gross margin. How will you reach gross margin? From the cost of goods available for sale, you subtract the gross margin and you will reach the, for that, you get to the rate of gross margin. And the rate of gross margin, from there, you get gross margin divided by the selling price of the goods available for sale. And this will give you the cost of closing inventory. So closing inventory at selling price less the rate of gross margin into closing inventory at selling price will give me the cost of closing inventory. So this is how we are trying to do. I will show you through a problem. Just look at it. You will solve it, and then you will get to do this. It's a very starting one is basic problem I'm given. You know, this is a sales during the year. You know, this is the purchases you have done. This data you all, when you're working in a company, we know how much sales have been done. We know how much is purchased. Opening inventories, nothing is there. And I have to find the non-historical cost of closing inventories, and I use the adjusted selling price method. So how will I get it? So opening inventory is nil here. First, I have the sales with me. Then I have the closing inventory at selling price. I added 50,000. I get 2,50,000 is the selling price of goods available for sale. Out of that, the cost of goods which are available for sale is 2 lakhs. That's the cost of purchases. Okay, that's the cost of goods which are available for sale. So my gross margin is 50,000. If there is any doubt here, you can ask me. Yes. Somil has a doubt. Yes, Somil, tell me.
सर एक बार ये प्रोसेस वापस रिपीट कर देंगे?
Okay, Somil, just say me, what is the sales given? Somil, can you
सर
hear
2
me?
lakh
2 lakhs is given. What is the purchase given cost?
2 lakh
2 lakhs. What is the closing inventory at selling price?
सर nil सर 50,000
50,000. So you have got a closing inventory at selling price. You have got
yes
sales and you have got the purchases also, right? These
yes
both
sir
figures are there with you. And opening inventory is nothing, zero. Now what happens is, I have got the sales, correct?
yes sir
But I don't know how many goods were ready to be sold. Means they
yes
have become finished goods to be sold. Okay. So the sales are 2 lakhs, which has already gone. Which is balance is there is, how much balance is there after the sales? Sumil, what is the balance goods? What is the price of the balance goods?
50,000
50,000, right? So when I add this 50,000, what I get? The total goods which are available for sale. So out of 2,50,000, I could be able to sell only 2 lakhs. The rest 50,000 remained with me, correct?
yes sir
Okay. But what is this 50,000? This 50,000 is the selling price of goods. So what I want now?
gross margin sir
Gross margin. For that, what I do? I have to find the cost of goods available for sale. Now, the cost of purchase is 2,50,000 is there. Definitely, if the cost of purchase is 2 lakh, that means there must be a profit inside.
yes sir
So this is the gross margin, 50,000. Clear now?
yes sir
Okay. But what we have to find out actually we have to find the 50,000 cost, 50,000 inventories cost. So what I do is this gross margin 50,000 and goods which is available for sale 2,50,000. I multiply it, I get my rate of gross margin is 20%. Now when I get 20%, so what is my cost of the closing inventory? The closing inventory cost is actually 50,000 less 20% on 50,000, that is 40,000. So once I got the rate of gross margin, I could find the cost of the closing inventory. So if there is any doubt here, please ask me. Shivana. Yes, Shivana.
Sir, after concluding all these, can we say first we find out what amount of goods we have for sale,
Yes, Shivana.
and we subtracted all the purchases. So we get gross margin, and after finding gross margin, we find its rate and multiply it with the closing inventory, so that we can the cost of closing inventory.
See, what happens is, we know that this data which is showing that inventory is at selling price 50,000 means inside that 50,000 there is some profit in it. Okay. That means this is the selling price. That means definitely cost price plus profit, some profit. It is showing the selling price. But what is the rate of that profit? We don't know. Unless we know the rate, we cannot find the cost of the closing inventory. Correct?
Yes, sir.
For that, finding the rate, we have to go through this process of finding the gross margin. Once I found the gross margin, I found the rate of gross margin. Once I found the rate of gross margin, then I can calculate my cost of closing inventory because I know the selling price. If you two things, if you know the selling price and if you know the margin percentage, definitely you can calculate the cross price and you can calculate the profit. Correct?
Sir, it will be given in the question that gross margin is on sale or cost.
Sometimes it is given, sometimes it is not given. So it depends on situation. When we'll be discussing some problems, we'll be finding where it is given, where it's not given. Okay.
Sir, when it is not given, then do we assume that it is on sale?
Profit is always on the sales only. Whenever you're selling some goods, suppose you have purchased goods for 2 lakhs. Why did you sell for 2,50,000? Why did you sell for 2 lakhs? Because you don't want to incur a loss, correct?
Yes, sir.
Okay. Now this is another information we have. So this is the goods which are received from suppliers, which are subject to trade discount and taxes. Trade discount is 3%, GST is 11%, packaging and transportation charges 87,500. and your sales during the year is 22 lakhs 45,500, and the sales price of closing inventories is 2 lakh 35,000. So always in this type of adjusted selling price method, you will be getting the selling price of the closing inventories. Now what we have to do is we have to find out the non-historical cost of inventories using adjusted selling price method. First of all, we have to see which is the cost. So up to packing and transportation charges is our cost here. So what you do is we have to take this cost to calculate the cost of the inventory. So what is the cost of purchases? Goods received from suppliers less trade discount, what 15,75,500 into 3%, 47,265. I have already discussed in the first theoretical discussion when I am doing of the cost of purchase. In the cost of purchase, what we do, we are deducting the trade discount. So this came 47,265, and we added GST at 11%. So we get 168,106. We added also packaging and transportation charges. It is 87,500. So finally, we got 1783,841 as the total determination of total cost of purchase we got. So once we got the cost of purchase, then we have to find the estimated gross profit margin. Now, what is the sales during the year? It's given. Always remember sales and you add the closing inventory. Both are given. You add it quickly. You add both of them. You will always get cost of goods available for sale. Given in the question, first find out whether you are given two things: sales during the year, closing inventory is given or not. If both are given, quickly add it. You will get cost of goods available for sale. Selling price of goods available for sale. Okay. Total sales of goods which are available for sale, you are getting 24,80,500. Then what you do is you deduct the purchases 1783,841. Then you get the gross profit. Once you get the gross profit, you can definitely get the gross profit margin. So if you deduct it from the purchases, whatever profit you get, you divide it by selling price of this goods available for sale, 24,80,500. This total goods, and this one you take it to find 28.09. Now you have to find the selling price of the closing inventories as given to you 235,000. From that, what you have to find? You have to deduct the gross profit margin 28.09% into 22,35,000. So you are getting 168,988. 168,988. You are getting the adjusted selling price. So if there is any doubt, you can ask me here. Fine then. So this I wanted to talk to you. This is a typical thing. Normally, whenever they sell any goods, as Somil was asking earlier, how will you know the gross profit? Normally, companies what they do, they use a markup of 25% on cost, like that they say. Suppose assume that there is a company where books are closed 31st December every year, and you have to track the inventory. Now, this is another aspect of this adjusted selling price. You are tracking the inventory. You are taking the inventory accounts and you are finding out what should be the valuation of inventory on that date. So for that purpose, you have to value the inventory, and normally 31st December means nobody can calculate exactly on 31st December. Some dates elapsed, and then you have to start like bank reconciliation. You have to go back and you have to check out and you have to make the inventory, ascertain the true value of the inventory. Now what happens? 31st December, what's the inventory? Miss it. But what happens sometimes? You know the inventory on 7th January. I may have the information on 7th January. Time has passed, some transactions happen. And then when I know the inventory status on 7th January, I have to find the inventory on 31st. And it practically happens. It practically happens this way. So at the time of audit, we have to find the true value of inventory. That time, what has happened in 31st December, you have to check it and track it. And that time, these things happen. So from January 1 to January 7th, this total 7th, this one, your sales has been 2,50,000. This is the sales we are going. Your purchase has been 1,53,000. So you got sales 2,50,000. purchases 1,53,000 from January 1 to January 7. Then what we have to do is, in that condition, we now have to find what should be the inventory on 31st December. So what happened is, inventory on January 7 is 7,85,000. Deduct the purchases 1,53,000. So you get 6,32,000 is the inventory. And to that, which is the inventory, you add the cost of goods which is sold during the period. So the cost of goods sold is 2,50,000 into 100 by 125, because your markup is 25% on the cost. So what you get is 2 lakhs. So total is 8,32,000. So you deduct the purchases and you added the cost of goods which is sold during the period, and you got the answer. Yes. Yes, Swana, tell me.
So once again, can you explain the part which is related to markup percentage?
Which one? Markup?
The markup percentage what we are taking up. Could you please once again explain it?
See, from 31st to 7 January, I have done sales of 2,50,000, right?
Yes, sir.
And purchases has been 1,53,000. Okay.
Okay.
How will I get the inventory? Inventory is always at cost only, right?
Okay.
Okay. Now you see, the sales has happened, this 2,50,000 out of the 31st December lot.
Okay.
Okay. Because the purchases is only 1,53,000. We are taking the non-historical method, right? So what we are assuming
So this
is,
purchases is before 31st January amount, sir?
you see, if you see the question, 31st December, you have to know the inventory status.
Okay.
You know the inventory status on 7th January.
Okay.
Okay, but I have to know the inventory status on 31st December. Okay. So what I have to do, what data I have with me, I know that 25% on cost is the markup price. Companies normally sell the goods at 25% profit margin. Correct? Okay.
Yes, sir.
So this is given. So I have been given sales, I have been given purchases. So what I do is, I have got the inventory of 7,85,000. Already it is there with me, right?
Yes,
so
sir.
from that inventory, some purchases has been added also.
Yes, sir.
Okay. So I'll deduct that purchase. Now
Okay.
when I deduct that purchase, whatever goods I get, okay, these are the cost of goods. These are the selling price of goods available for sale.
Yes, sir.
Okay. Then what I did is, out of that, this is the inventory which is on January 7th. And out of that, I deducted the purchases. So when I deducted the purchases, now I went back to the 31st January. But what happened in 31st January? I forgot to took those goods which are sold during the period.
I mean, a period before 31st December, sir?
No, just I'll again show you the diagram. Just see. Clearly, I'll show you. What happened? This is 31st December. Sales happened. Purchases also happened. Correct?
Yes, sir.
Now, what I did is, I removed the purchases, first of all. Because these
Yes,
are fresh
sir.
stock. Okay. So I
Okay.
removed the fresh stock. I got the old stock of 6,32,000. Okay.
Yes, sir.
But I am interested in finding the stock as on 31st December, which is required for my audit purpose.
Okay, sir.
In the meantime, from that, 2,50,000 has been already sold to the customers,
Okay.
which I cannot get back. I cannot ask the customer to give it to me for my audit purpose, practically.
Yes, sir.
So what I do that, I know that 2,50,000 invoices I saw, I checked it and I saw that this 2,50,000 invoices is from this lot which has gone to customers. So now I have to find that cost.
Yes, sir.
So how will I find out? I know that markup of the company policy is 25% on cost.
Okay, sir.
So to find the cost, 2,50,000, which is the selling price of goods, into 100 by 125 I did.
Okay.
Okay. So I got 2 lakhs.
Okay, sir.
Now this is that inventory which has gone out from my hand, which is not there with me.
Yes, sir.
You can say the inventory in transit. Okay.
Okay, sir.
So that 6,32,000 after deducting the purchase plus this transit item, this goods which are sold, is actually the inventory which is there with me in 31st December.
Okay, sir. Got it, sir.
Okay, got it. Okay. So
Yes,
from
sir.
that,
Thank you.
sales have been done and fresh purchases have been happened. Okay.
Okay, sir. Understood. I mean, the sales is something which is related to the inventory which was there before 31st December.
Yes,
And
that's
the
what is
purchases is the new
because you see,
purchases, sir.
purchases is only 1,53,000.
Yes, sir. Understood.
Understood. Okay.
Yeah. I mean,
So
the purchases is the new set of inventory, sir, whereas the sales which has been done for the past inventory which was there before
yeah,
31st
because
December.
you are selling on the markup on cost. That's why I said it is for a retail retail enterprise or where there are similar inventories. You can use this inventory taking methods. Okay. And normally,
Okay, sir.
what happens is they normally sell it from the past stocks only. Normally, companies
Understood, sir.
sell it from the past stocks only. So when you are checking the inventory taking, then you can find out from the past stocks only. So you found that the sales of 2,50,000 has been happened and it is from the past stock. Okay. So you know the
Okay.
markup policy of the company, so you get it. So first of all, we deducted the purchases to find the previous condition. What happened? Okay.
Okay, sir.
Now
Sir,
I
if
think
the
now it's clear.
company, the small, last I will be winding up, like if the company follows the LIFO policy, then the process will be different, sir.
See, now what we are discussing is we are finding the value of the inventory. Okay.
Okay, sir.
We are not using any FIFO, LIFO. We are actually now finding the monitoring the inventory control. We are having the inventory control. FIFO, LIFO is for the inventory valuation.
Okay, sir. Understood.
This is inventory taking.
Okay, sir. Thank you.
Okay.
Thank you, sir.
I would explain to you in the next class with another example. Okay. The
Okay.
same thing.
Okay, sir. Thank
I will explain with another example to make you the point clear how LIFO, FIFO, and this is different. Okay.
Okay, sir. Thank you. Thank you, sir.
Yeah. Yeah. I'll clear that out. I'll clear that confusion here. So next class, we will continue this inventory and we will talk about these valuations and inventory taking. Thank you, all of you.
Thank you, sir.
Thank you.